people may not be familiar with our trading styles and philosophies. And so I figured we could use this Let Me Explain to take a step back from the day-to-day market action and discuss some bigger level trading philosophy ideas. First and foremost, of course, is the notion that you said that fundamental news doesn't matter for traders, and it speaks to an efficient market hypothesis perspective. So, Tom, I was hoping that you could explain briefly as we work through some of these questions about trading philosophy here. What do you make of efficient markets? Do you find that markets are efficient, not just in the what you pay is what you get, the bid-ask spread being tight, but do you think that there are exploitable edges for traders and systems that traders can follow to make money in markets?
I do not. I do not feel that there are. Here, let me preface this. I think there are a few opportunities and cracks where there is some inefficiency in the markets, meaning occasionally you'll get an option that's mispriced because either nobody's following it or there's a big order or, there's a lot of confusion as to, volatility and pricing and, occasionally technology can mess up. So I can't say that there's never that, there's literally hundreds of thousands of different option series between listed options, futures options, and all the various derivatives markets out there. Technology makes mistakes. People make mistakes. Big orders can move markets. There's no question that occasionally there are opportunities that are where markets lose a little bit of their efficiency and they get a little bit out of line. However, for retail customers to think that they can operate within those parameters and take advantage of those opportunities, I'm telling you right now, it is virtually impossible. And the firms that do live in that world, it's super competitive. You need ridiculous amounts of capital. You have to plan on holding trades that you have no interest in holding for, a long period of time. And it's a very, very competitive, capital-intensive game. And it's only for professionals. On the retail side of the business, the marketplace is efficient. And everything we do, and the reason we're able to do all the things that we do and live in this world of law of large numbers is because we play in an efficient marketplace. The reason you can be a professional trader is because the playing field is level. The reason I don't believe you can be a professional gambler, for instance, is because the playing field is not level. I know people think there are such things as professional gamblers. I would argue that if there is, it's a minuscule number, and I don't even know how real that minuscule number is. So to answer your question is you can learn mechanics like what we do here at Tasty, and mechanics are really important because mechanics allow you to play on that level playing field. Without the mechanics that we preach and we talk about and that we research, the playing field is very uneven. It's very hard to know kind of where you're putting yourself at a disadvantage, even if the pricing is efficient. It's very hard to understand all that stuff. What we do at Tasty, which is so cool, is we kind of optimize the mechanics to put you in a position where, hey, you know what? I get why I'm doing this. And now hopefully, what I think whatever happens, but if what I think will happen happens, I will make money. And that's the position we want to put people in. There's nothing Tony or I or you or Ilya or anybody else on this network can do that will point people, to actually, we can't tell you what's going to happen next. We can't tell you this is going to make money, whatever. What we can tell you is, based on our research, we've optimized the strategy and the mechanics around that strategy and understanding what that underlying product is so that if you have an opinion, you can take advantage of it. That's it. That's the best we can do.
Tony, I know this week's a big week for macroeconomic data. We have JOLTS coming up in a few minutes at the top of the hour. We're going to have the GDP report this week. We're going to have non-farm payrolls. Do you think that traders should be paying attention to macro data like this to influence your trading decisions, or are those macro data points more for longer-term investors to consider?
I'll use your extreme version example of Boeing. I mean, Boeing was right where it is right now before all the news, if you want to interpret it as tariff news, bad news because nobody was buying the planes, etc. Whatever you want to do, stock went down $40. A lot of opportunity on both sides, bullish, bearish, to do something in there. Heightened volatility. Everything you look for here. I'm not saying you get short. You could get shorted on the news if that's what you think it is. But price is king. And it made a lot of opportunity for a lot of people to make some sort of money, or at least have a shot in the game where you had tighter liquid markets. Everything became, on the board there. Any strategy you wanted to do. So if the news or the numbers bring extremes, I think that gives us a chance to play. So I like when the market has economic news, but I can't benefit from direction from the news.
Yeah, I mean,
Tom,
here, I'm going to second what Tony just said about the reason that we like news is completely different than the reason most people like financial news. The reason we like financial news, and I can speak for Tony on this because we think the same way, is because it creates noise, which creates opportunity. That's what he was saying. Mm-hmm. The noise creates opportunity. We don't really care what that, we don't try to interpret the noise to give us a market direction. We just try to take advantage of the opportunity created by the noise. And he said it's based on price. Sure, that's based on price. Sometimes it could be based on volatility, but most of the time it's price. Mm-hmm. But that's what does fundamental. That's what that news is. That's the thing that drives opportunity.
Kind of expanding on that a little bit here, speaking of the opportunity here and the other side of it, actually, the risk. We can quantify risk. New traders can look at a trade and say, okay, 63% probability of profit. I'm going to risk $50 to make 200. But it's more than that. Do you find that as either of you have gone on through your trading careers, that risk is more than something quantifiable, that it's inherently psychological? Because what's an acceptable risk to me may not be an acceptable risk to you. How do traders work around that?
Well, you work around that. The only way, again, I'll let Tony speak for himself. The only way I know to work around that is to keep your trade size in place. It took us a long time to get there. It took us a couple of decades to get there, actually, but because we came from a different world. But it's just the only way you can normalize everything is through trade size.
I'm going to say the same.
I've rationalized that. It's taken me a long time to get there. But trade size normalizes everything.
Tony, you'd agree with that?
Yeah, I'm going to agree with that. Trade size and strategy, I guess, if I had to add something.
Okay, so then the question isn't strategy, right? It's really mechanics Tom, that you're getting at here, right? You're not going to stick to the same strategy all the time because the market conditions change, but you have to have a set of mechanics that you work around. At what point do either of you look beyond the mechanics and just go to gut instinct, or is your gut instinct in trading really built upon the mechanics that you've developed over decades?
No, I think they're two different things. I think that our gut instinct on price is not about mechanics. That's just about, that when it comes to us feeling that something's at a price extreme, that's just from watching the tape and watching the markets for so long. And I think that each one of us is different. I mean, I might think there's plenty of times when we're on the same page about price extreme, but there's plenty of other times when, I'm thinking, okay, now's the right time. And he's like, no, it's not. Or he's thinking now's the right time. And I'm thinking, no, it's not.
That's all subjective. Now you go to the strategy.
Yeah, it's all subjective. Exactly. So I think the price extreme and with respect to direction is something that both of us have just developed on our own. That is completely, we own that 100%. He owns his, I own mine. That's 100%. But I think that the strategic mechanics, the optimization of the mechanics, that we share together.
I think the point that you guys are sussing out here a little bit is that newer traders probably shouldn't trust their gut instincts up front.
Why?
Well, because you don't have those years of experience of tapering.
Who cares?
What else you got?
Who cares? Who cares?
Well, actually, that's what I'm trying to work into. Do you think that new traders, because they don't have that experience, should shy away from their gut instinct? Or
no, I don't think it matters. I don't think it matters. If you're asking me if my gut instincts are better in 2025 than they were in 1985, I would say no.
Oh, come on. You got to give a little bit of
Nope. I'm going to tell you right now, the markets are just as random to me as they were 40 years ago, 30 years ago, 20 years ago. The difference is that I've become more accepting of the fact that markets are random and that I don't know where they're going to go next. And I've become more conscious of size, so it doesn't matter as much to me. But if you're asking me if my instincts are better, no, my mechanics are better. So I don't get hurt as bad. But my instincts, they're still my instincts. I mean, like, how, if you truly believe...
Can't take the spots off a leopard kind of thing?
Yeah. Like, I don't think, man, I thought in 1985, I thought I could take the market every single day. And in 2025, I still think the exact same thing. But we're right about 50% of the time.
Right.
I mean, I really, like somebody that's doing something for the first time, in this case, it's almost like walking up to a roulette table and saying, you know what, I really think the next roll is going to be black. And the reality of it is, if somebody's been doing it for 25 years or somebody's doing it for their first day, the odds are still the same. But the difference is that we manage our bets better and we're able to accept the results better. And so for me, that's the difference. I need to be opinionated. I need to be directional because it's what keeps me going. I need to feel that I can tell when something's at a price extreme. I need to think that. Like you're never going to convince me that I'm never going to change from like not doing that. I'm always going to think that I know when something's at a price extreme. And sometimes,
even though you know it's random.
Yeah, and sometimes it works.
Tony, you seem to indicate that you think that your gut instincts gotten a little bit better over the last 30 or 40 years. What's been this most significant change, do you feel, in your gut that's made you a better trader?
Experience. I mean, I understand what Tom is saying. I mean, 40 years ago, I traded 4 options only. Like at the money.
I've watched him for 40 years. His gut instincts are no better today than they were 40 years ago. I don't care what he can say whatever he wants.
Come on.
Your gut instincts about which way the market's going to go? I wouldn't.
No, my gut instincts are probably the same, but I look at different things now. Now I've never looked at volatility before.
Of course, I'm not saying it, but you still don't know. If I said to you, what's going to happen tomorrow? You're no
I don't
better.
know direction,
Okay,
one way or the other. No, I
That's
wouldn't.
all.
No. But I could put more things in my camp to support what I think is going to happen, even though I know it's going to be random.
Chris, you got to look at the bright side here. I'll apply this to you. Okay.
This is going to be a dig on you.
And I'll say this in a nice way.
Do not talk about my haircut. Don't talk about the hair.
No, I'm not going to talk about the hair. You should be happy we think this way, because we don't bring people on board because we think they have any clue what the market's going to do. Like, I don't talk to you or Ilya or Pete.
I can stop faking it.
Or Victor because we think you guys have any clue what the market's going to do tomorrow. We would do the opposite more before we did what you told us to do. We would do the opposite. Every single person here. It's not just you. If you bring Scott in here right now, I would much rather do the opposite of what he thinks than what he thinks. So I think it's important for you guys to understand that, because not a single person in this firm was hired because we think they have any idea what's going to happen next. Like, do you think Tony and I would ever make a trade because Dr. Jim thought it was a good trade? We'd chop our own fingers off first, directionally. Now, if he said something about the math behind the logic and the, and how we think about, processing the
Hey, you
mechanics.
like ABC stock. This is a good strategy.
Right.
I would listen to
Optimizing the mechanics behind that. But we would laugh if he told us what he thought about a different stock. We think about that with everybody here. So why would we, I laugh when I see somebody on some network go, oh, this stock's a great buy, or some analyst that all they do is study one stock. I just laugh at it. It's a joke because I'm an efficient market theorist. I don't care what they say. But the noise that they create is interesting to me. That's it. And then the mechanics around it, I find fascinating. And there's a value to just having you talk about stuff. Like the value of Chris Vecchio is that you engage people with the chatter, whether or not, because maybe there's a few tidbits in there about some other thing that we recognize or that creates some encouragement, engagement, uncertainty, whatever it is.
So you might be useful. We just haven't decided.
Well, you're useful, but it's not for your market opinions.
Right. There you go.
Tony's been doing this for 14 years. I haven't listened to one thing he's ever said about a market call. What? You're going to tell me it's different?
You told me he comes across like the Charlie Brown teacher.
But I think it's important that people recognize that. When people call in with their trade assumptions, the reason we do them sometimes if they're directional is just because we're like, well, we don't know any better than they
I'll go to our confirm and send, not confirm and send. I'll go to our twice a week when we go to our viewers.
What's your assumption?
What's your assumption?
Yeah.
Anything like that. Somebody will come up with an assumption and they'll say they like ABC stock, and Tom will say, "Oh, I hate that stock," and do exactly the opposite, but apply the same strategy, maybe in a different direction. Not because that person's right or wrong or Tom is right or wrong. It's just that his gut feeling goes in that direction. It doesn't make the other person wrong. And then you have a nice tug of war and see who's right in the end. I mean, how many times does Tom say, "Oh, you took me down because I listened to what they said"? I mean, we know going into it, you couldn't do those two segments going into it if you thought that it wasn't random. If the mechanics fit, then it's workable trade.
I think that's the conclusion here, though, right? Like, you don't need to be, if you're new, if you're older, if you just started trading, if you've been trading for 40 years, it's not the noise that you pay attention to in the market. It's the mechanics and applying those mechanics to the market that you find yourself in and day out. So as newer traders who may be listening to Tasty Live for the first time, right, you don't need to be bullish or bearish on anything per se. You just need to know how to take the proper tool out of the toolkit and apply it to the situation at hand. And you have to start small. It's really about building up over time. Most of the traders who are doing this for a long time, in my experience, they go through drawdowns, they blow up accounts, but they have the tenacity and the perseverance to stay with it and learn from their mistakes. And they don't let any single loss bog them down at all. They just move on, right? Because it's a trade. You're not marrying these things. So
it's just a trade.